Bank of America earnings. The company came out with earnings of 17 cents a share. Revenue slightly higher than what analysts were looking for. With us right now from Charlotte, North Carolina, the bank's CEO, Brian Moynihan. Brian, welcome back to the Inside Track. There was some real meaningful improvement here for you in several of your businesses. Cards, notably the investment bank, you call it Global Markets, and also in wealth management, profit of more than $500 million a quarter. But everybody, you know, is going to be focusing on the continued losses in what you now call real estate lending, your home loans business. Tell me, can you see right now when that business is going to be profitable?
Well, I think, Eric, one of the reasons why we changed the name of the business is several months ago we separated the business into two components. The mortgage business going forward, and that which we bought from Countrywide that we need to just wind down, and it'll take some time to do that. And if you look at the business going forward, it's making a little bit of money, and the other business is obviously losing a significant amount of money. It's going to take several quarters to get through all this. But this quarter we made a significant step with a settlement on one of the major monoline counterparties, which has to do with the rep and warranty litigation, and that plus other charges were $3 billion in that line of business, which is a lot. But we keep powering through and made $2 billion overall in the company.
Brian, you can divvy it up into two things: ongoing losses in the credit portfolio, plus, as you point out, some of the costs that you're now having to bear for settlements, for litigation, these mortgage putbacks, as they're called, reps and warranties, and also the assessments and waivers. Can you tell me what it's going to feel like going forward, the mix between the credit losses and all of these expenses, these settlement costs that you have to pay?
Well, I think if you look at the overall company, you've seen the credit losses drop dramatically quarter by quarter by quarter. Even in our card business, for example, we fell below 8% for the first time in a long time this quarter. In a home equity business, which goes into the mortgage line of business, we dropped from almost by half over the last several quarters. So our losses peaked in the third quarter of 2009 and been coming down. There's still the piece that will be the slowest to bring down will be around the mortgage business, and that'll take several quarters. But the rest of the business has gotten in very good shape. The commercial business, which you didn't mention earlier, made our global commercial middle market banking, small business banking, made $900 million after tax this quarter, which is one of our larger earners, and its credit costs have come down dramatically. It's real estate. It has a commercial real estate portfolio in there, which has gotten in good shape. So it's really a tale of two cities. The rest of the company continues to push forward, as you laid out in your introduction. The mortgage business continues to hold us back, and we've got great customer activity in those other businesses. In the mortgage business, even though we held our market share in production, we got work to do.
Have you already recorded the cost for the foreclosure settlement this week?
We've been incurring the cost of the delays and of the work. The cost of the regulatory thing is already built in the run rate. If you remember, not a lot of people remember how that really came about. Is last fall there was a horizontal exam. The regulators came in. We took all their suggestions. We'd done a self-assessment on the issues that were out there at the time, and we've been working on that and stopped all foreclosures and then restarted them early this year. So all that cost is in our run rate. And I heard the discussion earlier is our expenses are higher than we'd like them to be, but a lot of that expense is due to the 2,500 people, 2,700 people we added in mortgage this quarter to continue to deal with the bad assets, while the rest of the company is actually down a couple thousand people.
So are you adding net people in the mortgage business? Because as you're aware, there's a report this morning that you're actually getting rid of some 1,500 people.
That started in March and will go is in April here, but that is on the production side. As the mortgage volumes in the market have fallen, our market share stayed the same, about 17%, but we've had to downsize that business on the front end side because the volumes aren't there, which is the nature of the mortgage business. It goes up when volumes are high, it comes down when volumes go down. But where we added a lot of the people is on the delinquent servicing side, helping homeowners try to keep their homes through the modification process. We modified 60,000 plus this quarter again. We've done 850,000 over the last couple of years. That's where we're adding the people, and that will peak over time and come down over the next several quarters. But that's where we're adding resources to do the right thing for homeowners and try to get through this effort.
So when does it come down? Because people are looking at this non-interest expense, Brian. They see more than $20 billion, way more than anything you had last year. When can you bring it back down to something under $17 billion, which you had in the second and third quarter of 2010?
If you look at the core expenses, Eric, they are about $17 billion. They're up about $500 million. And this quarter is a quarter we take a once a year charge for our employee benefits charge. There's some other charges in there, and we'll talk to investors later and show them. We're running about $17 billion a quarter as sort of core expenses. If you actually think about what we reported last quarter, it really was $20 billion. It had the goodwill in it. This quarter you have some about $3 billion of charges that are due to one-time nature charges that will go away in subsequent quarters. So run about $17 billion. But we announced this earlier this week that we have built a program to begin to look at everything we do in the company and move the stuff. You build up excesses in your company in tough times to make sure you're doing everything right. You have to throw people at stuff. And what we'll do is we'll drive that out over time in the latter part of this year, next year, and the next year. And part of that will be the peace dividend of having completed the merger integration. Part of that will be the cost to service the delinquent assets coming down as they're coming down, and part of it will just be looking at every business line we have and everything we do to become more effective for the customer and the teammate that's working with the customer.
Brian, you know as well as I do that M&A is really heating up here in the United States and globally. The commodities markets are on fire, and you're going to have to pay up for your bankers and traders, whether you want to hire them or whether you want to retain them. How much do you think you might have to raise the comp ratio by the end of the year in your investment bank to keep up with these markets?
We've hired, we have really all the people we need. We've hired people in our international business to do that. Our comp ratio has been fairly consistent quarter to quarter to quarter, and we expect it to remain that. Tom Montag and the team have done a fabulous job. Our market share is #2 in investment banking, and the trading business doubled its revenue from the last quarter. Last year was obviously an outsized quarter, back to about $4.5 billion. I think if you look at that, Tom's done a terrific job. We've hired the people, we got the platform we need, and now it's just grinding out the day-to-day customer interaction. So I don't see us changing those ratios and over time, because that's basically the way the business model works. And if you look at his returns, he's getting in the 20s a return on tangible equity in his business, and it's very strong returns, and we're very pleased with that.
Brian, you knew this question was coming. I have to ask you about the lack of internal disclosure around the Fed's dividend ruling. How do you explain that to investors without admitting that you have an internal controls problem?
There was no control problem. All the teams worked on it, and if people knew the facts, they'd be fine with it.
They'll be okay. So, what are the facts? What is it that we don't yet know?
The facts are we followed our process, and while we didn't probably do our best work in terms of how we handled it in the public relations side, the facts is we followed our process and disclosed what we thought was the right thing to disclose in the 8K that we filed.
Okay, Brian, one last question about the dividend. We know that for the time being, you're not allowed to raise the dividend, or at least restore the dividend. But first of all, when might it happen? Secondly, when you do it, will it be more ambitious than a penny? And thirdly, what's going to have to change in your capital plan to make that dividend possible, to allow it to pass muster at the Federal Reserve?
The current dividend's a penny, so it'd obviously be higher than a penny. We had work to do in this company that we knew we had to do in the first half of this year around continuing integration of the platforms, around continuing to implement risk management systems and optimizing balance sheet, preparing for Basel II and Basel III, and doing that work, and also continuing to take risk out of the company like we did with the FSA assured settlement today. And that was the work we knew we needed to do. That was the work that we talked to our regulators to get done, and we got to get that work done. And when we're done with that work, then I'm sure that we'll be in a position to get the dividend increased. That work was not supposed to be completed to the first half of this year, and that's why we told investors going back very early this year that we wouldn't ask for a dividend until that work was done.
All right, Brian, thank you for joining us. As always, Brian Moynihan, the Bank of America CEO. Brian, as you point out, you've got some work to do in mortgages and on expenses, but as we discussed, meaningful improvement in cards, not mortgage banking, investment banking, and also in wealth management. Brian Moynihan, the CEO of Bank of America.